Hey everyone, me Kevin here. We're about to get lazy and learn about building wealth. Let's go. Now, in case you don't know me, my name is Kevin. I go by Meet Kevin. I make YouTube videos, but before I ever made YouTube videos, I became a real estate millionaire. At one point, having up to $26 million of real estate, at the same time as having an over $20 million stock portfolio. And folks, now we're gonna talk about building wealth. And in this video, you're gonna get all of my insights into exactly how to do that in a Noob versus Pro format. Noobs do stupid things. Pros do smart things. Let's get started. The first thing that noobs do is when it comes to value, they have a mindset of, you owe me. That is, my boss owes me a raise, and I'm owed a cheaper house or cheaper rent. A pro says, no, I owe you. I owe society, and I'm gonna work harder to make a good reality happen. Then we have age. The noob says, well, I'm only 18. Why do I have to worry about this? Or I'm only 30. Why do I have to worry about this right now? Or I'm making more money than my friends, so I'm good. Why do I have to worry about trying to make more money? The pro says, I've got to always figure out how to not stagnate. How can I make sure I can make more money next year than I did this year? Maybe that means getting a license in lending or accounting or becoming a real estate agent or a Series 65 registered investment advisor license. So that way you are always growing and building your resume. That's what the pro does. The noob says, nah, I'll worry about that in the future. Then when it comes to risk, the noob, of course, says, what if I fail? The pro says, what if I don't try? The noob says, I've always got to have an emergency fund around because, what if an emergency comes up? The pro says, no. If I have a bunch of money sitting around in a savings account, I'm going to feel like I'm richer, that I can spend more money, and I will end up spending more money on stuff I don't need or stuff I don't want or a fancier car payment or whatever and delay my house even longer because I have all this money, so why wait? The pro says, real emergency funds are your opportunity to break the glass and actually do something that hurts to get access to that money. You actually have an emergency. It should be like breaking glass. So what's the difference here? Well, the noob leaves their money in a savings account. The pro puts their money in an S&P 500 or total stock market index fund and leaves that money available as their emergency fund because they realize the odds are the market will grow more than it will ever fall. And even if the market fell 50%, they'd still have a 50% emergency fund available. The pro says, hey, I'll just assume that my stocks are worth 50% of whatever they actually are, and then I'll have my efforts dedicated to getting a larger emergency fund. Now, when it comes to passive income, the noob says, I need passive income so my dinner tonight is paid for, and this vacation is brought to me by all the money I just made on my dividend stocks. The pro says, why would I try to have passive income when I'm trying to build wealth? Passive income gets taxed in the year that I make it. When I take dividends, I get taxed. My goal is to delay my taxes to when I'm retired. So that way the amount I'm taxed is the lowest possible percentage. And the best way to avoid passive income taxation is by not focusing on passive income. It's by focusing on passive wealth. Passive wealth is the appreciation of real assets like stocks or real estate. As the value of your assets goes up, you don't pay anything in taxes until you sell. Speaking of stocks, the noob has absolutely no idea who they are. That is, they don't know if they're a day trader, a swing trader, a short-term options trader, or a long-term diamond hander. They're clueless. A pro says, I have my portfolio allocated to be, let's say, 80% long, 20% for swing trades, and maybe within that 20%, 1 to 2% speculation. Just for an example, a pro knows about upside and downside hedges. For example, a pro might say, I've got $3 million to invest in the market, and I'm feeling FOMO that I want to go all in right now. But they might say, you know what, I'm going to take a small upside hedge, a small out-of-the-money call option to prevent me from going all in. If the market goes up, the out-of-the-money call is my upside hedge. If it goes down, I'll lose on the upside hedge, but I'll make money investing the other cash I had at a lower amount. Now, look, we've got a lot more noob versus pro things to talk about in this video, but I just gotta say, some things are gonna be a little tricky. You're gonna hear things that might not make the most sense, but there is a ton of extra detail, and all of that extra detail, whether it's about real estate or stocks, investing, building wealth, whatever, is found in my program's link down below, and you could use coupon code CYBERKEVIN to get the best pricing on my programs on building your wealth, stocks and psychology of money, real estate investing, real estate sales, making YouTube videos, property management, you name it. All of the information is in detail in the program's link down below. But let's keep going on Noob vs. Pro. Back to Noob vs. Pro. A noob looks at stock price and the value of their portfolio and gets nervous when they see red and happy when they see green. A pro gets happy when they see their quantity of shares owned going up and sad when the quantity of shares owned goes down. See, this is the difference of P's and Q's. Noobs just care about P. What's the price of my stock today? What's the value of my portfolio today? It's like if they have a real estate property, they want to see it on Zillow every single day. The pro says, I know I have a good investment, and in the long run, it will be worth more. My goal right now isn't worried about the day-to-day fluctuations. It's worried about quantity, getting more properties, getting more stocks. Now, most noobs in the stock market or even in real estate want to get in because prices have gone up. How you doing? It's going.
It's going slow.
It's lazy. Thank you. The pro realizes that there can be macroeconomic cycles where there are better opportunities to be patient with cash than to buy when there is peak speculation, euphoria, or often recently in stocks called momentum. Be careful of investing when momentum is at peak. I gotta get some momentum. The noob doesn't understand eudaimonia, the ancient Greek definition of the good life. The noob says, if I can't be the best, I won't even try. I'll just get by. The pro doesn't need to be the best at everything, but realizes they could be a great investor. They can be a great real estate agent, a great CPA, a great investment banker. They don't have to be the best computer programmer. They just have to be a computer programmer and do their best that they can do. Doesn't mean they won't be the best in the world. And see, that's a difference. The noob fears not being the best. They don't understand that eudaimonia is about the balance of life. Having a balance of being good at a lot of things, but not being horrible at one thing or the absolute best at another thing. Balance. The noob goes to Universal Studios and says, I'm gonna get the cheapest ticket and I'm gonna spend 3 hours in line to go on one ride. The pro says, I'm on vacation with my family. I'm going to maximize our opportunities to have a great time together, and we're gonna get the fast passes. We're gonna spend a little extra to make sure we can share the best experiences together. See, that's because the noob cares about things. The pro cares about experiences. Things are relative. Oh, you have a better car because statistically on paper, your car is faster or more expensive. The pro says, I went to a vacation in Hawaii. How are you going to compare that? How are you going to compare how good of a time I had on my vacation versus your vacation? You can't. Experiences are where you spend money, not on stuff. Which actually brings up guns and butter. Noobs invest in butter. Butter are things that go down in value over time. Oh, I'm gonna get an Apple Watch. Oh, I'm gonna get a new outfit. Oh, I'm gonna get a fancy refrigerator. All these things go down in value over time. I'm gonna get a new sofa, $5,000 sofa, because maybe it'll last a year longer, and they justify buying butter expenses with rationalizations that are nonsense. The pro says, I'm gonna get a $500 couch, and when I need to buy another one in 3 years, I'll do that. But in the meantime, I'm gonna invest the rest of the money, because the pro knows you always spend the vast majority of your money on things that go up in value. Real assets, stocks, real estate. Everything else is butter. Now a quick 90-second message from our sponsor.
Now, I know some of you like to trade, but quite frankly, we don't really get to trade like the quants on Wall Street because they're hiring computer scientists and they got all these crazy algos. But what if I told you that without needing to be a wizard in Excel or knowing how to code or having expensive terminals and coding technology, what if I told you there was a company called Composer that gave you the financial firepower to build no-code trading algorithms yourself? For example, do you want to say buy Tesla if Ford drops 10% over 5 trading days, short Ethereum if Bitcoin hits $50,000? Well, Composer lets you do exactly this, and now you too can compete with those quants. With Composer, you can drag and drop and seamlessly edit templates that cater to your exact investing style. For example, I can take an existing Composer strategy like buy the dip NASDAQ and edit it to invest 70% in the top 10 holdings and 30% into the rest. It's so freaking easy. Companies like Citadel and Bridgewater are consistently delivering outsized returns, and not by picking stocks, but by letting algos take advantage of us. So it's time we fight back and use the technology that we have available to us, like Composer, a no-code super tool that lets you invest just like the big funds. No engineering degree required. Use my unique link in the description down below to sign up for Composer. So make sure to use that link in the description down below and at least check them out. You can see the disclosures in the description as well.
The noob thinks about real estate and first thinks, I gotta have 20% down. I don't have time to get to 20% down. I got bills to pay. The pro says, I'm not worried about how much I'm putting down. I'll put down 3%, but it's going to be 3% on a home that I'm going to live in for the first year, and maybe I'll rent it out in the future, but it's going to be 3% down on a good deal. Here's why. The noob says, oh my gosh, if I only put 3% down, I'm going to pay so much money in interest over 30 years. The noob doesn't understand the time value of money, that the investment grows more than the net. So the noob looks in a $400,000 neighborhood and says, well, I need 20% down, so I'm going to have to save up 80 grand plus closing costs. This sucks. But I'll be able to avoid mortgage insurance, and I'll be able to spend less debt over 30 years because they don't understand the time value of money. The pro says, I'm going to go in that same $400,000 neighborhood. I'm going to find that $300,000 fixer-upper. I'm going to go with a 3.5% down renovation loan on this property. I'm going to write a beautiful letter to the sellers, and I'm going to pay more than the cash buyers. And what am I going to do? I'm going to buy that house, put my 3.5% down. After I fix it up with the extra maybe 10% of money you set aside, 30K or so, you're going to refinance that property. You're going to get rid of your mortgage insurance, your FHA lifetime permanent mortgage insurance. And now you're going to have a $400,000 property that you spent somewhere around $40,000 on, which is less than half of what the other person spent. And you now have an equity position of over $80,000, plus when you refinance, you're taking out the difference between your first loan in the 280s and 320, which is almost like getting a refund of $30,000 on top of that. So it's almost like you got this property for $10,000 down and people say it's not possible. I do it all the time. See, the reason is noobs care about white picket fences and remodeled dream homes. They're lifetime forever homes. Pros look and say, that's bullcrap. There's no forever home. What I want are as many fixer-uppers as I can get my hands on, wedge deals, below market deals, where I can build equity by doing simple things like rental grade remodels, IKEA kitchens, paint, carpet. Why are you spending 50 grand on a kitchen? You've ever gotten a quote for a kitchen and somebody said it's going to be 50 grand? You'll waste the money. But see, the noob doesn't know because the noob doesn't even know how to communicate. They talk to contractors. They say, I need this done. I need you to do this. I'll have you do this. The pro says, hey, would you mind helping me out? I'm on a shoestring budget. I got to find a way to get this rent ready. The noob doesn't understand the basics of communication. The noob doesn't understand that people don't want to help somebody who's mean and demanding and grinds on price. The pro realizes, hey, I want you to make money, but I want to make sure we're on the same page. This is a rental grade remodel. What can we do to save money so that we both make money? The noob thinks that means you're a slumlord, but the noob doesn't understand there's a difference between brand new and the highest end thing you can buy and what's safe. The pro investor invests in things that are safe and quality at a reasonable price. The noob spares no expense on their dream home and everything else because they don't know that they don't even know. The noob doesn't understand economics and says prices are going up because corporations are greedy. The pro realizes that prices are going up because more people are demanding the same things that I want, and therefore prices are going up. The same is true in politics. The noob says houses are expensive because greedy Wall Street corporations are buying up all the homes. Oh my gosh, it's always the greedy Wall Street corporations. Might have nothing to do with me. It's them. It's always somebody else's fault. Well, when you point the finger, three tend to point back at yourself. So when politicians point the finger at greedy Wall Street corporations, they don't even realize that they're the reasons America can't build enough homes. because our bureaucratic governments make it too difficult to provide the free market supply of homes that we need. And that is a problem decades in the making. Politicians won't realize it because it's unpopular to say the truth. It's much more popular and applause-worthy to say it's the greedy Wall Street corporations. And then nothing ever changes because they're not actually solving the problem. And see, that's another thing between noobs and pros. Noobs want to go in front of a group of people or on social media and do something that'll get a lot of views, that'll get a lot of attention, that'll get a lot of applause and cheer. They're afraid of social ridicule. Pros will say, no, we need to get to the bottom via first principles of what is actually factual and right and what is the real solution. Expensive houses? Build more homes. How can we build more homes? We streamline regulation to make sure we have a proper balance of speed and safety. But that's not popular. AOC can't go on Twitter and say, hey, we're going to fix the housing crisis by streamlining building codes to make things easier to make sure we can get more affordable housing. It's much more popular to blame those greedy Wall Street corporations. And see, that in communication is the difference between a noob and a pro, and it doesn't just apply to politics. It applies to everything. Look at the folks around you who say the most applause-worthy things. Are they simply restatements of claims, or are they providing actual facts and data? Noobs say, you know what, if I can lock in a profit and if I have to pay taxes, that's okay. Pros will always position to make sure they can lower their tax basis over the long term. And here's a way you could do that with housing. The pro realizes that they may own real estate that today is worth $1 million and in the future is worth $20 million. And if they decide that when they're 90 years old, they've had it with tenants and toilets and they're going to sell their real estate, they'll probably pay taxes on the full $20 million via long-term capital gains thanks to longer-term depreciation. Don't so much worry about that. Just know they'll probably pay taxes on the full $20 million value of their portfolio. That would work out to about $4 to $5 million in taxes, depending on the long-term capital gains rate in that state at that time. The pro realizes, wait a minute, if I'm 90 and I have a $20 million taxable portfolio, and I happen to die in an accident with my spouse, well, the next day my children can sell this $20 million portfolio with a stepped-up tax basis completely tax-free. Now, of course, once you get above this sort of threshold, around $20 million for a couple, you start running into estate tax issues. But trust me, if you're at that point, you got other things to worry about. The noob looks at their 401k and always makes sure they take every single percentage of match that they can get from their employer, be it 3, 10, 50, 100%. They max their match in their 401k every single year. And every single year, they also maximize their Roth, because the Roth grows tax-free in your account over your lifetime. But the pro also makes sure to prioritize real estate before focusing too much on a Roth, because here's a way we're going to end this. If I had put all my money into the stock market, my spouse and my money, $18,000 at 18 and 19 years old, our money invested in the S&P 500 over the next 10 years would have tripled. We would have been pro investors. We tripled our money in index funds. Oh my gosh. We now, instead of having $18,000, have $56,000. But what did we do instead? We bought a wedge deal. Because we focused on wedge deals with that money instead. More principles, of course, that you will learn in all the programs linked down below on building your wealth. We were able to turn that $18,000 not into $56,000 or a triple. We turned that $18,000 into a more than 12x in 1.5 years. $250,000 in 1.5 years. And that's because when you're starting out with a portfolio of less than $500,000, your goal should always be real estate first, stocks second. None of this information in the video is financial advice. It's for entertainment purposes only. After all, I'm just a YouTuber floating around in a lazy river with shorts that are way too short. But if there's one thing I can tell you, it's don't be a noob and learn how to be a pro. Link down below.